My name is Dan Coatsworth. So I'm going to talk to you a bit about markets and then go over some stuff about building a portfolio. So just wanted to sort of set the context. This year's been really good to be an investor. About 28% return if you're in the US stock market. Sort of 14% from places like Germany, India and Japan. A little bit less from China and UK. But overall, it's been really good. And I think as we move into 2025, there's probably three key things that people are thinking about. And this is really important if you're thinking about building a portfolio or making amendments to a portfolio for your retirement. In America, obviously, Donald Trump is going to return to the White House. So far, the stock market likes it. US stock market, new record all-time high the other day. Businesses seem to like it. They're going to get looser regulation, cutting tax. What's surprising me is that the market's not really worrying about some of the implications of Donald Trump's policies. Immigration and tariffs are going to essentially will push up costs for businesses. That could drive up inflation. It's exactly the opposite of what investors have really been looking for. Over the last couple of years, investors were hoping that the rate of inflation would slow down. We get interest rate cuts, and that is starting to play out, but it's threatening to kind of reverse to back what we had last couple of years again. In the UK, the budget decisions are already pointing towards extra costs for businesses from employer national insurance, from changes to employment rights, increase the national minimum wage, all these things. So because that points to companies, they're either going to have to accept lower profit margins, they're going to have to make job cuts, or they're going to push up prices. And of course, pushing up prices drive up inflation again. And in China, we've got Beijing's announced a big economic stimulus program. For a while, there's a lot of excitement again about China. From an investment perspective, it's been unloved for a while. But what we're seeing from the latest data is, I think, unfortunately, what lots of people have feared is that these stimulus measures are not having a long-lasting effect. They're really short-term. So I think there's clearly lots of things that are going to be on everyone's minds as an investor if you're exposed to any of these areas. But I think the key question from a retirement perspective is, does any of these things, do they really matter if you've got an investment time horizon for 10 plus years? This is a chart of one of the global stock market benchmarks, the MSCI World. Over the last 10 years, you can see there's been ups and downs. We've had some difficult periods. But if you've been an investor and you've just held firm and just sat it out, you would have ended that period with greater wealth than when you were at the start. I can't guarantee this is always going to happen. History suggests that with investing, if you're patient, time in the market, that's what really counts. So I think if you're building together a portfolio, thinking about what might happen in the next 2, 3, 4 months, to me, that's not building an investment portfolio. That's day trading. I think you need to think longer term. So I'm just going to skip these for time purposes. But these three golden rules you need to think about. Know your objectives, investing time frame. So we're all here because we're interested in the topic of retirement today. So your objective in that situation would be investing to fund your life after you finish working. Investing time frame, that will differ for everyone. But it really does matter, and I'll come to that in a second about why that matters so much. You need to be comfortable with the level of risk that you're taking. Quite a lot of investors think, okay, well, I'll do some maths. I need to get, let's say, 10, 15, 20% a year. That will give me the amount of money that I need to fund the lifestyle that I want later in life. But to get those sort of returns, you might need to take high risks, and not everyone's comfortable with that. I think if you're worried about investments and you wake up at night and you can't sleep, you need to rethink your risk appetite, i.e. perhaps look for lower risk products. I think it's really important as well to spread those risks. We talked a second ago about things that might happen, challenges ahead in the UK, China and America. But if you're not all in just one area, what you really want to see is part of your portfolio do well when other bits are not doing well, and to act as a sort of support measure. some people, when they're investing for retirement, will just be paying money out of their pay packet every month. They're drip feeding it in. Some will have a lump sum, perhaps if they've inherited money, or they might have transferred their pension. A lot of people go through lots of different jobs. They realise after a while, why have I got so many of these pension pots? I just consolidate it into one pot. It's much easier to manage. And so lots of people ask me, is it better to drip feed or to money into a pension, or is it better just have one lump sum and do everything at once? There is no magic answer. If you have a lump sum and you invest it right way, you're benefiting from time in the market. But also it might be that you're investing exactly at the point where markets start to fall. But you need to think about these different things when you're putting a plan together. Now, you can invest in individual shares, but for the purposes of this discussion, I'm going to focus on funds, investment trusts, and ETFs. So tracker funds or ETFs, I appreciate some of you in this room will probably already be invested. You already know about them, but this is for the purposes of those who are not quite sure. Passive funds, essentially, they will track a certain part of the market. For example, if you had a FTSE 100 tracker, and if the FTSE 100 goes up by 5% in a month, your fund will do exactly the same. Over the longer term, your fund might lag it slightly. That's just taking into account the fees that you get on the passive funds. Now, these fees are typically lower than you'd find with an active fund. That's because with passives, they're following a set of rules, i.e. a computer is telling the system what is in that index and what to follow. Active funds is when you're paying for a fund manager or a team of fund managers. Their job is, because they're charging a little bit more, a lot of people are happy to pay that because the fund manager's job is to try and outperform the market, whereas passive funds will simply track the market. So with investment trusts or unit trusts or OICs, the decision whether to go with them is up to you. And I think importantly, you don't need to choose one or the other. You can have a portfolio that has either of them. Some people like to have actively managed funds, perhaps in areas which they're less confident. So emerging markets is a good example. There might be lots of interesting companies in there, but they're not household names to a lot of people, perhaps in this country. So they're happy to use the services of a fund manager in that situation. In terms of where you want to put your money, I do think there's a lot to be said for spreading your money around, putting it into different parts of the world, into different sectors. They don't all move in the same way. You have something like the healthcare sector, technology sector. There'll be different drivers here. I think if you have a blend of things, the goal is to try and smooth out the returns in your portfolio, not have things wildly moving up and down. When you're investing for retirement, you have to think, do I want income or growth or a bit of both? I think if you're in the sort of the wealth accumulation phase, you may not need to actually draw an income from your retirement. So you'd perhaps reinvest any dividends that are paid. So when you see a fund name, it might have AC or INC in it. So AC stands for accumulation, essentially means it automatically reinvests those dividends. INC stands for income and means it pays out any cash in dividends as cash. Always go to a fund's website or fact sheet and check what it's meant to be doing before you put your money into. Don't get caught out by thinking, okay, I kind of guess from it. Sometimes these funds are not quite what you think when you dig deeper into them. So always have a look. So the best thing is to go to individual websites, you should have it, or the asset manager's website should have the information. So lots of people ask me, how many funds should I put in my portfolio? I always think, well, let's think if you've got a portfolio, say, of 50 funds, and they each holding 100 stocks, 5,000 stocks, do you need that exposure to that many? If you brought that number down to 10 stocks, you might be able to have a better idea what's in them. You can see if there are any funds are exactly holding the same thing. Lots of funds are all invested in the same area. The question, do you need to keep up to the same? Think about, again, spreading those risks. For example, on number 3, you're heavily dependent on one sector for returns. A lot of people get drawn to certain sectors, whether it's oil and gas or technology, and they go all in. And they don't realise that when those sectors are out of favour, it really sort of can cause their portfolio to upset them, have bad sentiment. But so really, spread those risks. Only keep as many funds as you feel comfortable monitoring. And so here's an example of perhaps how you want to build it. It's something called a core satellite approach. So a core would be putting the building blocks of your portfolio. Satellite would be layering stuff around it that might be high risk or you're interested in. So just to give you an example, this has got 60% in a global equity tracker fund. That's your core. Around the side, the rest of those 40% is split equally into an emerging markets fund, into private equity, a bit of property, and some small cap stuff. Now, these numbers are not set in stone. You can have any sort of variation you like. Some people will say a core might have 75 or 80% of your money in there. But it's just that mentality of thinking, if you want to have specialist stuff, maybe think about sprinkling it around the edges. AJ Bell's website, hopefully you've all seen it, but if you're not, it's got really good tools on there, how to search the market. We have a fund, an investment trust, ETF screeners on there. So essentially, these are good search tools. So you can go on there and search by different criteria, like certain performance or certain fees, different managers. And that will help narrow down the whole market into something a bit more manageable. AJ Bell also has its team of experts have gone through the market, and they've highlighted some of what they call their favorite funds and also some of the investment trusts on a select list. Now, these have been highlighted for various different factors, and so I do go and have a read of what they're there. Because they've each got a report written by someone in AJ Bell why they think that they've got certain qualities you might want to be aware of if you've not come across these products before. We've also got our own funds. We have a pension builder fund, starter portfolios. I won't go through those now, but there's lots of different options for you. So do have a good thing. So I say, when you are doing a portfolio, putting one together is really worth doing a bit of research before just diving in. So I'm going to put all these various things into some 3 examples here. We'll start with Lucy. She's 35. Now, she's got 30 years before she's going to retire. So she's happy and she's comfortable taking higher risks. So she's decided to go for a global fund with the core satellite approach. So she's got half her money in a global fund, 20% in a tech fund. So you might think that 20% is quite high, but she's obviously got lots of time on her side before she needs to access that money. And she's happy. She understands that there will be ups and downs in the market, and she will ride those out, hopefully. She's also got a bit of money in private equity, in emerging markets, and a little bit in small cap. So this is sort of, in her circumstance, is a plan she thinks will work. Now, as she gets older, that plan will probably change. So Bob here is 55. He thinks he's got about 10 years to go until he retires, but he might retire earlier on. So he hasn't got as high an appetite for risk as the previous person. He's gone for a global equity tracker fund as part of the core portfolio. And what he wants here is to still grow that portfolio, get some capital returns. But he's also got a little bit, much more of an income sort of perspective in there, with a bit of corporate bonds and also from the property investment trust. Now, gold's in there, not because gold doesn't yield anything, but he's got it in there as sort of, as a hedge against uncertainty, and I think this is what people like to hold gold for. In case of times of strife, it always seems to come into favour. There's no guarantee that will happen, but that's that's his strategy. We've also got he's interested in healthcare. At 55, the idea that we're a bit more aware of health issues facing the older people, and so he's got a real interest in it and can see some opportunities for that sector. Now, compare that to Jackie, who's 65. She's just retired, and she's got a different perspective again, and this is guided by age. She still wants to grow investments. You might think, okay, well, 65 doesn't, isn't that just about collecting income from that sort of age onwards? ONS data says someone in Jackie's situation, female, 65, in good health, the average living age is to 87. But there's actually a 1 in 4 chance that she could live until 94, according to these statistics. And so she uses the 30% in income-generating shares to hopefully keep growing the value of her portfolio, while at the same time the bonds and the property will give her cash on a regular basis, which she could then use to pay the bills. And again, she's got a bit of sort of the safety net, safe haven, sort of uncertainty hedge, 5% in gold. So again, these things, it completely is different per person. I must emphasize that. This is not a one-size-fits-all approach. But just finally, before I finish, is to think about portfolio rebalancing. Because if you make a plan and you want to say, okay, I want to have a certain percentage in this area, certain percentage in that area, if something does well in your portfolio and something doesn't do well, those percentages can easily go out of sync. So something called rebalancing is to go back, sell a little bit of what you've done well in, buy a little bit more of what you haven't done well in. And that's to hopefully put your plan back in line. When to do it is an interesting question. Normally, I would say you just want to do this once a year. You don't want to be doing this on a weekly or monthly basis. You really don't want to sort of fiddle with your portfolio regularly. So I appreciate this is, for some people in this room, you may already be well down your path. But like I say, for those who are not sure or want to sort of start to get a bit more serious about your retirement, hopefully that will give you some pointers. So thank you very much for listening. Thank you.